Okay, hello, how's it going? Welcome back to my channel. We're doing a basic video on option trading. This is something I love. I'm super excited about this conversation. I want to make this video as accurate as I can. Everything you need to know, option trading, let's go. So this is, before we get into the numbers and the technicals and the math and all the exciting things that you need to know, I want to tell you just an overview. Option trading is a lot of fun. It's very risky. It's very challenging unless you understand all the different parameters of the mathematics behind the options you're trading. There's a secret. Don't be greedy. It's a secret. And there's just this last week, you could have taken $1,000 and turned it into $100,000 in one trade. $1,000, $100,000 in 5 days. That's possible. It happens every week. You just got to know how to do it, how to spot it, see what happens. And I'll tell you what trade that was, and we'll talk about that later. But before we get into it, let's just talk about the basics of option trading. Let's just talk about the basics, okay? So I feel like this is something that I'm going to bring up my phone, and I'll put the screen up so you guys can see what I'm looking at. We're going to bring up just my basic watch list. So I'm going to screen record this. Now, this is my basic watch list. I'm going to change things on this consistently. The goal here with option trading is, especially when you first start, is for you to pick one asset to be really good at understanding the trade range that it's in and when it moves and why. We'll get into that. But option trading, what it is, basically, if we were to say, let's say we wanted to buy 100 shares of Apple right now, for how much would that cost us? It'd be $15,000 to buy 100 shares of Apple right now. Let's say Apple goes up $5. Boop, boop. 155. We have 100. So we make 500 bucks about, right? So you know Apple's going to go up $5 this week. Maybe you don't know it, but you think it's going to happen. You could buy 100 shares of Apple, and when it goes up $5, you make 500 bucks. Not too bad. You risk $15,000. You make 500 bucks. Option trading, if I was to go in my WeBull app, I'm going to show you my mobile app what I do. If I go to options, and let's say, well, this week just ended, and so you can see every week, depending on the different assets. Some assets have monthly contracts, some assets have every 3 days, like SPY, but this is basically the time parameter of the contract. So just stick with me, just follow. Let's say next week, which is 7 days away, I know Apple's going to go up to 155, right? This 155 contract I can buy for $31. Maybe on Monday it'll open, I'll buy it for 30 bucks. I can buy this contract for 30 bucks. Let's say I bought 2 of them. So I buy 6 for 60 bucks. Let's say I buy 3, so I risk 100 bucks. I buy 3 of these 155s. I spend $96. Right? And if I'm right, when I'm right, that week, Apple goes up to 155, which means that this contract inside the money up here is going to be worth $220. And if I have 3 of them, I make $650 total. I spent 100, so I'd make $550, the same amount that I would make by buying 100 shares, I can make by buying 3 contracts for that week. Now, the challenge is, let's say that I'm wrong and it doesn't go to 155, it goes down. Those contracts could be devalued to only $7 each. I could lose money. If I had bought shares and it goes down, I would still have shares at the end of the week. If I buy this contract for 155 and at the end of the week it goes to 154, like let's look at this week. Market just closed, which is why I wanted to do this. If I bought 150s for this week, which if we go look at their history, I could have bought them for $3 and sold them for $31. Pretty good return right there. So I could have bought 10 for $30, sold them for $300, all inside today. And then by the end of the day, if I had held them and not sold them back to the market, they'd be worth 0. So there's a very, very risky time parameter with options. See, futures and options are similar. Futures and options are different by the way that you have a limited time frame for you to be right. So, all right, now I'm looking at options on Apple that are 7 days out. And if I look at 155s, they're $31. If I go look at a month out, and I look at 155s, they're $173. The reason why is because I have more time to be right, which means it costs more money. So people usually don't buy weekly options because they're so risky, because of the possibility that you could lose money by being wrong even by a few dollars. Car. Now let's just go back to the basics here. This is the weekly options that ended today. Now you can see today, because it ended at 149.80, it's not at 150. Anything after that is worthless. But earlier in the week, because there was potential for it to go here, these were worth possibly up to $25 up until this morning when it opened down and they became devalued to nothing. And you can see inside the money, the further inside the money the contract is, the more value it has. So these contracts at 140 are worth $995. But if you would have bought them 5 days ago, way back here, you could have got them for $800. That's not the greatest increase, but you could have sold them here at this peak for $1,300. And so they're so far inside the money that they're worth more because they're actually right, which means that you bought a 140 call and it went to 149, so it's above 140. If you bought a 150 call and it expired this week and it doesn't go to 150, it becomes worthless. Now if you look, I'm at calls on the bottom right here, so I can change it to puts, and you can see the same thing happens but the other way. I could have bought puts. I could have said it's going to go down this week by a few dollars, and maybe this 155 earlier in the week would have been worth $300 or so, and then opening today it would have been worth $900, $800. But then if you wait all day, as it starts to come back up, it went down to about $500. So the value of the contracts changes based off of mathematics that we can see right here. If we scroll to the right, these are basic terms for option trading. We have our delta, gamma, and theta, and these affect the price of the option. And this affects the value, the inherent value of the contracts you're holding based off of the time and the price movement. Okay, so let's just think about the basics of option trading as far as what are we doing. So if I'm going to buy an Apple call, let's say I'm buying one Apple call for next week for 155. Basically what I'm saying is I'm reserving the right to buy 100 shares of Apple at 155. The thing about option trading is if you look at the history of option trading, it was originally created as a way to hedge against purchasing shares. So you would buy puts on something, and as you bought a bunch of shares, and in case it went down, the puts would make you money, and you could put that capital back into more shares, hypothetically. So what we want to do is sell these contracts back to the market. We don't want to hold them. We're not trying to buy 100 shares of Apple. And if we were trying to buy 100 shares of Apple, we would probably do a covered put or a naked put. We would do a naked put if we were. So if we were going to try to buy 100 shares of Apple, we would definitely do a naked put, because then we would get option premium in return for buying the shares. We'll go into that. It's a little bit more of an advanced strategy. Naked puts, covered calls, they're great. We can talk about them. We might not get into them in this video, but we're going to go through as fast as we can to cover as much as we can quickly. So if I buy one contract for Apple to go to 155, it basically means that I'm reserving the right to buy 100 shares of Apple at 155. If it goes to 155 that week, and I don't want to buy 100 shares, the option contract increases in value and I sell it back to the market. If it decreases in value and I'm lucky to not hold it till it goes to zero, I can still sell it back to the market, potentially at a loss. Now there's rules with options usually where I say you don't hold a day contract longer than a few hours, you don't hold a weekly contract longer than a few days, you don't hold a monthly contract longer than a week, and you don't hold a contract that goes below 50% of value. So it's hard sometimes to hold on to the contracts that are going to keep running up and keep making gains, and it's easy to hold on to the contracts that are losing money and you think, well, I'll just keep holding it, it'll eventually come back. You have to learn how to set a stop loss for yourself and say, I've lost 50% of the value of the contract, I'm going to sell it just so I have cash so I can play again tomorrow. That's really important to understand how to do, and it's really important to remember to do that. So let's say we wanted to buy puts. It's the same idea. I'm going to reserve the right to buy 100 shares of Apple at a lower price, and if Apple goes down there inside the week or the month that I bought, I can change the value of whatever contracts I purchased to the value of whatever's inside the money. And the real benefit would be if you could purchase something super far outside the money, like plane. When I talk about inside and outside the money, I'm going to go back to calls really quick. If I'm looking at this 149 call, because it's a call, which means I'm expecting it to go up, and because Apple's stock price is above 149, it's in the money. It's inside the money. All these other prices that are outside of the price of the asset, they're outside the money. So even if we change it from calls to puts, we can see it's the same thing where this 150 put is inside the money and these other puts that are further down are outside the money. And so the stock asset price you can see is a line right through where it is, and you can change back and forth between calls and puts. Now, the thing that's really challenging to do is to catch changes in assets and then not get greedy and overhold. So let's say you woke up today and you bought 700 calls this morning. 0 days are very risky, but if you learn how to do them, they could be fun. Let's say you woke up this morning and you bought these 700 calls for $5 each, which means you could have bought 100 of them for $500, and then it goes up to $24 each per contract. You could sell them all then for obviously $2,500 because you have 100. You could have done that with just one. You could have turned $5 to $25. You could have done that with 10. You could have turned $50 to $250. But then, if you had not sold those contracts right there, and the Netflix had gone down throughout the day, you would have been all the way back to what you purchased them at. Maybe you could have sold them for a little bit of profit near the end of the day. Sometimes that doesn't always happen. And then at the very end of the day, they go all the way to zero. They're worth nothing. And you can't sell them back to the market because no one's buying them. Now, this is something that we're going to talk about, which is really important. Let's say we're going to change away from this week because this week ended, so they're all zeroed out. I'm going to go to next week. Now, next week, I'm probably going to say Netflix is going to go to $700. And if I buy this for $580, you can see the last price right here is $580. Then I potentially could make around $400 when it goes up $10. That's not that bad. That's not a bad gain. Almost 100% gain right there. But the further outside the money I go, let's say I bought this $730 for $115, which is the last bid price. Then, if it goes inside the money, obviously I make a lot more money, right? Exponentially more money, almost 10x instead of 2x. So the challenge here is that when you start looking at further and further outside the money, the spread is bigger. Now, if you look at the spread, it basically means at this 770 call, or maybe this 765 is a good example. If I look at the 765 call, the spread, and you can see it right here, it's the bid and the ask. If I go look at this and I go to next, it shows me there's 11 people bidding $20 on this call, and there's 16 people trying to sell this call for $70. Now, the further out the money you go, the less liquidity and the less volume there is on some of these options, especially when you get to assets that nobody's trading on. So that's why you need to find assets that have high volume to trade options effectively, which is why you pick, a blue chip stock usually, or something that has a lot of volume in it and a lot of liquidity. Even Netflix has a lot of liquidity. The calls for next week, there's such a big spread on them because people that have bought them possibly a week or two ago for $10 are now trying to sell them for $70 because they have a lot of them. And people who just now realize they're going to be worth $70 or $50 are trying to buy them for 20. And so you can see if I go to limit price right here and I hit mid, it fills it for a mid price. And that's usually what it'll fill for. The challenge is, especially if you're trading on Robinhood, that's why I would encourage you to sign up for WeBull and do all the option trading you can on WeBull, because Robinhood does the thing where like you can set it at 45 and it'll just fill it at 70. And if you're option trading and you buy 10 of these for 70 instead of 45, that's really bad. That's how you lose money, always. And what you can do is realize, because the mid price is 45, that people are bidding 20, you can say, I want to buy 10 for 25. And that means you're going to spend 250 bucks and you basically get a lower entry price, and the market's going to fluctuate inside the day enough to where these further out of the money calls, you want to put that low bid price in because you want to capture that lowest bid possible. Because even then, if I bought 10 right now for $25 and then they filled and then the market looked like maybe it wasn't going to keep going up, I could sell them right away for profit. I could sell half of them and I'd have 5 of them almost risk-free. So I'd be able to let those ride. So there's definitely potential for you to make intelligent moves and not be taken advantage of, but you need to understand the math and the metrics and the movements of the market. And what often happens too is there's implied volatility that happens, like next week, market opens, I buy these 765 calls and Netflix shoots up to 730. I could sell those contracts then for a lot more money because of the implied potential of Netflix going to 765 that week. And if it just spends the rest of the week flat at 740, the value just drains out of the contracts the rest of the week. So it's hard to time and catch when it's going to be a momentum pop that you can take value out, or when you should hold until it all goes all the way in the money and you make 10x. So these are the basic concepts of trying to like make sure you don't overpay for your contracts. Is just looking at that bid and ask and thinking about it. Like, hypothetically, can I set the bid somewhere that's low enough to where as soon as the contract's purchased, I'm already in the profit? That'd be a really great entry position. And if you think about, the same thing happens when you start getting into more complicated trading strategies where you want to buy both options, both calls and puts at the same time, and maybe you want to buy them right inside the money or right outside the money on both sides. Maybe you want to buy them very far outside the money on both sides. These strategies are a little more complex. That's called a strangle. The other's called a straddle. There's a challenge to option trading that is obviously very risky and it's addictive. The first time you take 500 bucks to 5,000, you'll be like, wow. And then you might proceed to lose that 5,000 on crazy stuff. So if you guys want to see the option trade that we were talking about just this week, basically Tesla was a $1,000 to $100,000 play. These 990s right here. See how these 990s ended in the money, worth $12,000? Check this out. These 990s, and I was holding these, I was in on this last week. It's not even going to show it, is it? There we go. Last week, on like Thursday, you could have bought these for, oh, it's not going to show, there you go. Well, when I saw them, they were 120 to 160. But it says they're like 200. Well, I don't know. They're about $180, $200 a contract for, this was last week, for 990s for this week. And as soon as it opened on Monday, Tuesday, it went straight to like 13, 12, 11 to $12,000. So basically every $200 you put in could have turned into $12,000. So hypothetically $2,000 would have been $113,000. But that would be really hard to hold because you just don't know and it doesn't always work out. But if you bought them way down here, last week, about 10 of these bad boys for wherever, like somewhere around there, I guess. And then you bought 10 and you sold 10 here. Whatever that is, close to 12, close to like $116,000 on 2,000. So that's 1 week on Tesla. Obviously, that was a really crazy week for Tesla. If you look, Tesla was like pretty flat for a minute and then it just took off. So that's what really makes option contracts explode in value, is when something stays the same price for a long time, like it consolidates for a long time, and then it has a lot of movement very quickly. And it could be up or down. So either way, you'd want to buy calls for up and puts for down, obviously. And the reality is too, is that this stuff's hard. It's hard to time, it's hard to predict. It's not always easy. That's why you pick one asset, follow it. I really like Apple, Netflix, my big ones, Apple, Netflix, Tesla, TQQ. They're super easy, they're fun. I'll give you guys a little bit more of a breakdown on some of the more complex option trading strategies in another video. Mainly because I just feel like this is probably long enough for this video. Covers the basics of what you're doing inside the WeBull app. If you guys don't have the WeBull app, you can use the link in the description. You get 2 free stocks when you sign up. If you sign up, you get a free stock, and when you add $100 to your account, you get a free stock. And it could be great stock, it could be like a $4 stock, I don't know. They say you could win Apple or something, but we'll get into further complex option trading strategies in the next video. I just wanted to cover some basics and show you guys the idea of basically every week, QQQ, TQQ, SPY, Apple, like the potential for you to buy weekly, monthly contracts and assess, like Apple just had earnings, right? And so it just basically all year is going up until it goes down and it finds a kind of consolidation price and it goes up again. So if you look, maybe Apple's going to go down next week. Maybe it'll consolidate a little bit at like 150. And then I would say look out for buying some contracts for 160. So we can take that into basically January of next year to be really safe. You could buy some 160s for $300. The problem is if you hold these too long, since they're super far out, if you hold these all the way till the week of, and you only make $200 on a contract you paid $300 for, then you're going to be really upset. So don't do that. Don't buy something really far out and then hold it when it's outside the money like that. If it's really far inside the money, obviously, if it goes to 170 and you're holding the contract that's 950 and you bought it for 300, that's cheers, good times. But that's why you got to find the middle ground of like how far out is safe for me not to lose money, and when will it move? When will it take that jump up or down? So learn an asset, pay attention to it, get used to its trading ranges, get used to the parameters it trades in normally, and watch for those big patterns and look for contracts that you can get a good low bid on. That's how you make big bucks. Pow! What do you think of that? Okay, so let me know what you think. I'll do more option trading videos. I'll cover more complex trading strategies like how to buy 100 shares at a specific price by writing or selling puts, how to sell calls by buying 100 shares of something that you like and selling calls so you can actually make money. Selling the calls that you're buying right now, you can sell them to other people, and if they hold them until they go to zero, you keep all that money. So we can go into that stuff in another video, but for now, join WeBull. Tell me if you like this video. Tell me what you guys are thinking about. Should we do some live trades? Should I make an effort to try to like bring you in on some of the bigger option moves that I'm thinking about doing? Let me know in the comments. Have a great day. Cheers, subscribe, like, all the things. Thank you so much. I'll see you next time.
Brought to you by